As the Indian government prepares to unveil its upcoming budget, there are a number of key priorities that the government has to focus on. At the top of the list is the need to invest in infrastructure in order to support the country's ambitious goal of becoming a 10 trillion economy. Now, this becomes one priority. With rising inflation and a decline in rural consumption, it is also essential to focus on boosting rural consumption. This becomes another priority. With geopolitical tensions on the rise, now is the time to invest in defense and ensure the country's security. And with the looming threat of another wave of COVID, it is as crucial to ensure that the country's healthcare infrastructure is robust enough. Amidst all of these pressing priorities, one area that should not be overlooked is the development of renewable energy, as the government has made a commitment to reducing its dependence on fossil fuels. Now, given the 2024 elections, there is also an expectation that the budget could be populist in nature. Now, we see that the budget is a complex document that requires balancing multiple priorities. It is not meant to be a single document or a one-time exercise. And let's be real, budget हर किसी को please नहीं कर सकता. But that's the nature of this tightrope walk. It's a juggling act of priorities where 10 different things need to be done. And if you ask me to list them all, I would probably miss 15 or 20. But let's not forget you and I, who are the crux of this budget. It's all about us and how it will impact us as individuals and investors. In this episode, let's delve into this complex puzzle that is the union budget. Let's begin. You're watching Informed Investor, the Third Empire, initiated by ResearchAndRanking. Imagine the Union Budget of India as the ultimate financial game plan. The government sets out their strategies for income and spending for the coming year, like a coach planning a winning game. Investors, economists, and policymakers all tune into the finance minister's budget speech. It's like getting a sneak peek at the game plan. And just like how a game plan can determine the outcome of a game, the union budget can also impact the overall sentiment of the economy through the announcement of tax changes, subsidies, growth initiatives, etc. Now, to understand a budget, it is important to know the terms and concepts used in budgeting. My colleague Raj Mehta has already delved into some of the most important terms that you need to know in order to understand a budget. By watching his presentation, you'll gain a solid foundation of knowledge that will allow you to easily navigate the budget and make sense of the various figures and numbers. So if you want to truly understand the budget and make the most of this episode and the upcoming budget, make sure to watch Raj's presentation. Now, are you ready to dive into the budgeting world? In this episode, we are taking a closer look at what matters most to you when it comes to budget priorities. Now, we conducted a survey to gather pre-budget expectations. We asked you all to provide your perspectives on the budget, whether you would view it as an investor or as a common man. Now, to give you all more context, let's understand through an example how a common man and an investor would view the budget. For example, as a common man, Rahul wonders how the budget will impact his daily life and if there will be any relief for his household expenses. Now, as he looks through the budget, he would expect a reduction in the tax bill or an increase in exemptions. As an investor, Alia is always on the lookout for policies that will boost the economy and provide more opportunities for investments to grow. She sees that the government has announced plans to increase infrastructure spending, which is a positive sign for the economy. She also likes measures announced to attract foreign investments, which will increase the flow of capital into the country. Overall, she feels that the budget should be pro-growth that would benefit her investments in the long run. Now, we asked you to put on the hat of an investor or a common citizen and to share your expectations for the upcoming union budget from each viewpoint. It's an interesting exercise as it forces you to think critically about what you believe is more important. But be warned, once you start viewing the budget through these two lenses, you may find that one hat fits tighter than the other. Now, the results of the survey suggest that more than 60% of our clients who responded to the survey chose the hat of an investor, indicating a desire for more economic development and growth. However, this focus on growth may also mean that they expect the government to invest more and potentially be less populist among the general public. The survey results suggest that a reformatory budget which prioritizes economic growth is preferred over a populist budget which focuses on leaving more money in the pockets of citizens. Now, only time will tell if this union budget would be incremental to the previous one, or reformatory or populist. Having said that, we did list a couple of initiatives or reforms that we believe that the government should prioritize in this union budget, and we asked you to rate it. Let's see your responses. One of the key areas that investors will be keeping an eye on in the upcoming budget is any change in taxation rules. Now, rumors have been circulating that capital gain taxation rules may be adjusted. As you can see on the chart on your screen, the history of long-term capital gain tax in India has been a roller coaster ride in the last few decades. From 20% to 10% to 0 and back again to 10%. Now, currently, equity investors don't have to pay tax on capital gains if they make less than rupees 1 lakh in a financial year. Beyond that threshold, they have to pay a 10% tax on their gains. Now, the tax laws on capital gains are complex and confusing for the average person. As you can see from this chart, tax rates, holding period, and indexation availability vary depending on the asset and other factors. So we see a need for simplifying these rules. In recent years, we've seen a surge in capital market participation in India. However, the stock market participation rate in India is still low compared to developed economies. Now, if that taxation regime is favorable for investors, we believe that participation in the stock market will increase. Now, announcements in this regard could also likely bring cheer to investors and the stock market as a whole. While most of you all believe that tweaks in long-term capital gain tax was imperative, about 25% of you all did have a neutral stance. Now, do write to us on why you all hold a neutral stance. We are quite eager to hear your perspective on it. Like every year, regular folks like you and I look forward to the union budget announcement because we are all hoping that the government will lower the taxes we have to pay so we can keep more of our money. While the new tax regime brought in fiscal year 21, the tax rate for individuals has not been changed since fiscal year 18. Likewise, the Section 80C limit of rupees 1.5 lakh has remained the same since 2014. Now, the demand to lift the exemption limit under this section has also strengthened in the recent days. So people are really curious to see if the government is going to change this year. Now, considering the inflation rate impacting the cost of living and the effect of recent pandemic, individuals like you and I are certainly experiencing an impact on our cash flows. Hence, any move to leave more disposable income in the hands of individual taxpayers will also boost consumptions and make us happy. The concept of a wealth tax on the super rich is gaining popularity, especially after a recent Oxfam India report highlighting that the widening income gap in the country. Now, according to the report, just 5% of Indians own more than 60% of the country's wealth, while the bottom 50% of the population possess only 3% of the wealth. The topic of a wealth tax on the rich has many different opinions because it is a complex and multifaceted issue that can be viewed from a variety of perspectives. The debate about a wealth tax is as complex as a Rubik's Cube, with opinions ranging from it's necessary to tax the rich to it's an economy faux pas that will harm the economic growth of a country. While there can be different opinions, one thing is for sure that there is a growing inequality, not just in India, but globally too, and this needs to be addressed. So what exactly were your responses on this? In our survey, most of you all who responded found wealth tax on the rich to be very important. Do write to us on why you believe wealth tax is important or not at all important. The pandemic had caused weak demand and put a strain on the livelihood of those in the rural areas. Now, rising farm input costs and other inflationary pressures have limited the growth in income for the rural economy. Do know that the rural economy contributes about 46% towards the national income and about 25 to 30% of India's GDP. Therefore, it is extremely essential to focus on the growth and development of India's rural economy in our journey to becoming a 5 or even a 10 trillion economy. Now, it is clear from the results posted by a wide range of FMCG companies that the rural consumption of the Indian society have been impacted. Dabur India stated that demand trends for the FMCG industry remained weak during the December quarter, with rural markets continuing to remain under pressure. Now, with the rural economy still recovering, it is crucial for the government to focus on policies and initiatives that will support the growth and development of the rural economy. Now, this includes measures aimed at boosting demand and private consumption, as well as investing in infrastructure and creating jobs. Now, since this will be an election year, the government may announce some benefits and policies aimed at the rural sector to boost languishing demand. The fiscal year 24 union budget is expected to remain focused on pro-growth initiatives such as continued investment in infrastructure. Since the pandemic, the government has rightfully raised capital expenditure. Now, capital expenditure relates to funds that are spent on building assets like roads, ports, buildings, etc. Now, the previous budget for fiscal year 23 had allotted rupees 7.5 lakh crore as capital expenditure, which was a significant 35.4% jump over fiscal year 22. But this question still looms. If indeed fiscal year 24 is a year of economic slowdown, then should the budget aim to boost growth or pursue fiscal consolidation? We think public infrastructure spending should be stepped up further in fiscal year 24, but without compromising on consolidation. The central government's fiscal deficit of around 6.4% of GDP is nearly twice its pre-pandemic average of 3.5%. The government indeed has a tough rope to thread because a balance should be struck between supporting growth while sticking to path of fiscal consolidation. However, the government could do away social measures related to COVID-19, such as the vaccination drive and subsidies towards food grain disbursements. Now, with strong revenue receipts, there may be some headroom for capex in infrastructure. Being self-sufficient in terms of defending a nation's sovereignty is crucial in today's geopolitical climate. Now, having a strong defense system, including air, ground, and sea-based warfare capabilities, can deter potential aggressors and protect the nation. Now, defense, however, is a costly endeavor requiring significant capital expenses for the latest technology and weaponry. Now, in recent years, India has become a significant exporter of weapons, and it is unclear if this trend will continue. But given the geopolitical uncertainties, increase in defense outlay becomes another priority, and most of our survey respondents agree to. Now, next up is the widening of the scope for PLI scheme. The Union Budget fiscal year 22 announced an outlay of 1.97 lakh crore for the production-linked incentive scheme in 13 sectors. Now, the PLI schemes have been introduced to boost domestic manufacturing, to enhance employment opportunities, to reduce imports and to increase exports. Now, basis estimates from Credit Suisse, the PLI scheme can generate $150 billion in incremental sales by fiscal year 27, adding up to 1.7% to the GDP. Now, the success of the PLI schemes has set the ball rolling for more ambitious schemes for new sectors, including the most desirous initiatives for the development of the semiconductor and display manufacturing ecosystem in India. Now, after seeing positive results, the government is likely to increase the allocation for the ongoing PLI schemes. And most of our survey respondents also agree for this to be of utmost importance. Healthcare has been a major topic of discussion in recent years, particularly with the ongoing concern about new variants of the virus. Now, issues such as sexual and reproductive health, diabetes, mental health, and poor rural healthcare infrastructure are some of the other issues. Now, it is generally accepted that the government should spend about 3% of their GDP on healthcare. Now, India's government has recognized this and set a goal to increase healthcare expenditure to 2.5% of GDP by 2025 in its 2017 National Health Policy. The pandemic has led to a significant increase in the healthcare budget, bringing India's health expenditure to 2.1% of GDP for the first time in fiscal year 22, which is close to the government's goal. However, it should be noted that the government health expenditure was only 1.2% in the pre-COVID year, that is fiscal year 19, and had slightly decreased from 1.3% in the previous fiscal year. Now, our investors also agree on the importance of healthcare spending given the situation. Now that we've discussed the several priorities, we do understand that the government faces a difficult task every year as it presents the union budget. On one hand, there is the need for fiscal prudence, ensuring that the government's finances are managed responsibly. On the other hand, there is the need for pro-growth initiatives that will help boost the economy and create jobs. Now, balancing these two objectives can be a tough task for any government. The government must consider the needs of all citizens, from farmers and small businesses to the middle class and the poor. But with limited resources, it can't satisfy the needs of every single individual. It's a bit like trying to please everyone at a party. You want to make sure everyone has a good time, but you can't make everyone happy all the time. Similarly, the government can't satisfy the needs of every single individual or sector in this budget. It has to make tough choices and prioritize what is best for the country as a whole. In short, the government's job of balancing fiscal prudence and pro-growth initiatives in this union budget is a delicate balancing act that requires a lot of skill and expertise. It's not easy to make everyone happy, but it is important that the government tries its best to make sure that the country's finances are in order and that the economy is growing. Having said that, this is me, Merlin Susanna, signing off. Take care and stay invested.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.